Hello and welcome to the Harwood Report for October 15th, 2018. I'm Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. Let's do disclosures. All services and content are provided for educational and informational purposes only and should not be considered legal or financial advice. Take a moment, please, to read through the rest of these because they are important and my lawyers will be much happier knowing that I've presented this to you. All right. Let's talk about what happened. So, last week was quite the pullback. A little reminiscent of February. Interest rates spiking a little bit, put some fear into the market. We're basically working away from the there is no alternative stock market of 2017. Remember the old phrase, Tina, you got to be long stocks because there's no alternative to get yield. So you buy stocks that give big dividends, and that's how you get yield. And then that just helps drive the stock market higher. Well, now as 10-year yields get above 3%, people are starting to say, well, maybe I should be allocating my money into fixed income or other stuff, looking for diversification. Is that what's driving the market here? Maybe a little bit. Maybe a little bit of fear about the fact that we're going into earnings season. Maybe a little bit of fear about what's going to happen with China. A little bit of fear about what's going to happen with Saudi Arabia. A little bit of fear about what's going to happen with Italy. A little bit of fear with what's going to happen with Brexit. There's a lot of little elements of fear. And then maybe we're playing the blame game when we talk about the interest rate impact and saying that that's the driver. So where do we go from here? Well, first off, fear and greed is 12 now because everything is fearful. Except for this thing that's junk bond demand that I've been saying for weeks means nothing because all you can see here is that, it was high at the end of last year. It's low at the end of there at this point, and this has had nothing to do with the equity markets. If anything, maybe this, yes, it's been grinding down. That's been going along with the stock market. But in 2017, it was going higher while the stock market went up. So who gives a damn what this stuff means? Sorry, pardon my French. The other stuff is showing extreme fear. VIX has spiked. S&P has collapsed. Stocks have, this is just another, image of the same market momentum. The 5-day average put call ratio, everybody was trading puts, not calls. Lots of stocks made new 52-week lows, more so than in February. But that's, because some of these stocks have been laggards. And then, that's also seen in this breadth measure where it's basically down to where it was at the lows in March. So we've seen a lot of reasons to have some fear in the market. And that drove stock prices down through the 200-day moving average for a day. We're basically sitting at the 200-day moving average now in the S&P 500. It seems like the market is trying to basically decide, do we go up, do we recover, or do we collapse? Well, the recovery process is simple. We see a double inside day here. So we had the range yesterday. Friday's range was tighter. It was a higher low and a lower high. Today is a higher low and a lower high than Friday. This is creating a little bit of a coil. The market is basically distributing here at the 200-day moving average, chopping around. Shorts are covering some of their positions, longs are getting out still. You've got a question mark of where do we go next? Well, some of the signals from that actually can come from the underlying elements. And I'm personally believing right now that the S&P 500 looks like it wants to bounce back to this 285 level, somewhere near the high of the original drop. Maybe it's a repeat of what we saw in February where that bounce is a sellable bounce because we're going to press back to the 200-day moving average. But maybe this is just a blip. We're not sure yet. Let's look at the chart for the first move. And my first scenario is a move back towards 285. Volatility is one of those indicators that is telling me that maybe this is starting to become a viable dip and that it's really starting to calm down. If you want to look at another way to look at that, it's skew. So the skew index, it's not loading for a moment here, but the skew index had started to come down. So basically people were selling some puts into this rally. Why is this frozen on me? Well, we'll leave this chart and we'll look at the charts here instead because these are a little bit, also a bit interesting. Skew I can't pull up here, but you can see that VIX is starting to come back down. And then we move over to the other two main sectors for me, and that's tech. You can see that tech held up well against the 200-day moving average, better than the S&Ps. And IWM, which had been the laggard, is getting money rotation today. So it is still under the 200-day moving average. It has a long ways to go to get above the 200-day moving average. We're talking 4% to get back there. That may or may not happen this week. This is the one to watch because this is the lagger. If everything else firms above the 200-day moving average, I got to think money flow starts to rotate back into the small caps because small caps generally do best in a bull market. And these have really not gotten to that point where they've gotten overbought like crazy into the highs. If the next leg higher is driven by small caps, that may be the ultimate high that starts to pull this market back down, create that top, and let us start to think about maybe the fact that the 10-year bull market is coming to an end. I still think it's intact though. This was a little bit fear, a little bit of concern here, what we saw here this last week. But to me, I think that the most likely resolution is up. You want to know how to trade that with the volatility where it is. You can see it's high in Qs, it's high in IWM. Then you got to sign up for the premium product, and I'll give you, and you can see it on the page you're looking at probably, but if not, I'll give you a link at the end of the presentation. And that includes a week for free as a reminder. So don't forget that your subscription comes with a free week so you can test it out. Make sure that you like it before you start paying. Let's go to the bonds. There's not a lot of clarity for me in bonds. We did this pullback. This could just be a dead cat bounce. You can see the trend line basically forming right there. We're starting to create a wedge, similar to the S&P 500, but I'd say that if this breaks to the downside, that's a little bit concerning for the stock market. If it breaks back to the upside, then that could just be money flow going back into the market, overall capital investment. Less clarity for me in the TLT trade than anything. GLD last week I was espousing that this could start to create a rally, and you could see that it did start to bounce, but now the vol has gotten really high. Where I'm a little more interested is SLV, and I'll show you why now. SLV has lagged. It's just barely above the 50-day moving average, where GLD has pressed a little bit more through it, basically. SLV has lagged a little bit, and the volatility has lagged a little bit. 18.5% here in vol for SLV is not too crazy. It's basically at the highs, not way above the highs. And you can see that in the option landscape. The other thing that's nice with SLV is if I go to, like, say, November 2nd, you can just see the skew here. The implied volatility of the 14 calls, which are 20 cents out of the money, is only 19.25. The implied volatility of the 14.5 is 21.5. There's this call skew, which is natural in the commodities market, and particularly in precious metals. But that gives me a little bit of a volatility edge, where if I can buy 19 vol here, which is a little bit high, but sell 21.5 vol, which is even higher, I get a benefit. I talked through a little bit more on that sort of stuff in the premium product. I kind of gave you a freebie there, though. It's an interesting setup in SLV. Finally, we're going to go to the oil markets because oil has gotten a pullback. So we got everything going on in Saudi Arabia and the stock market. Those two things have now driven us a little bit lower because tensions in Saudi Arabia are bullish for oil, because we have to worry about Saudi Arabian production coming offline or sanctions or whatever else. Those tensions seem to be easing, which is a bearish input for oil. Also, the equity market collapse is a bearish input for oil because it's a commodity that trades off of industrial demand and basically global growth. So if the global growth story looks bad via equities, then it can also look bad in oil. From here, we're doing the same sort of setup. Inside day. We're just trying to get set up to get some clarity. And as we wait for that, I kind of want to wait on XLE. Look at how high that vol has gotten. It's still high. It could come back down. In reality, historical volatility is at 26%, so short-term volatility was high. If we're just going to calm down and maybe play for stability, I think that's kind of the way I can play XLE, is looking a little more at stability. As always, OIH is a little more explosive to me, but you can see the rally that we've already had of up 1% today with oil stable and XLE down. So it's clearly there's some people, I think, starting to recognize that OIH has that potential for upside, and I think that there's a potential for a short squeeze there. If volatility comes down much more, down towards 28%, 27.5%, I think there's a real opportunity here. As it stands, there's ways to trade that for a little bit of a bounce and then look for the squeeze once we get through this consolidation area. Because if we can get a close above the 200-day moving average that actually holds, and that's at 25.87, then I start wondering about that move to 28, 29, or even 30. For now, playing for a bounce to 26-ish isn't too bad, and with volatility high, there are low leverage ways to play that, and then look for the leverage play if the volatility comes down. So that's it for today. I mentioned it a few times. The premium report, Harwood Report, is $49 a month. The first week is free. I give a newsletter that I already sent out that shows a little bit more specifics on trade ideas that I have, again, for educational purposes only. But we also do more videos every Wednesday, and I give trade ideas and updates basically as we go through the week. So if you go through this whole thing, $49 a month, it's a steal. But you also get a week for free, so there's no real risk to you if you sign up now. Give it a try and see what you think about it. You can always reach out to me, Keith@tradeacademy.co, if you have comments or questions. Love to hear from you guys, and hope you have a wonderful rest of your trading day. Have a good one, guys. And gals.